It's an area we should give much attention. Okay? So, as we discuss this area, it's good to know what is all about company valuation or business valuation. Here, it's just a process of determining the company valuation. Company valuation is the process of determining economic value of a whole business or a company. You are trying to get the value of the company, the economic value of the company. In short, you're trying to find how much is this how much is this company worth? At the point you are trying to value the company, you are trying to find how much is this company worth. And along the way, you will find that it is very, very important to actually know the value of the business or to know the company's value. Okay? And you are going to apply different techniques to actually determine this company's value. And you will need to know why do you actually need to determine the company value. Okay, these are some of the questions they can actually ask. Why is a company valuation important after all? What are the techniques you can use? And from those techniques, what are the limitations of each technique? What are the merits of each technique? Under what circumstances can you use a certain technique? So those are some of the theoretical areas they can ask here. Why is the company valuation important? It's something that you need to know. They can throw the question taking like 5 marks. Taxation purposes. Taxation purposes, depending on the transaction happening. Strategic planning and performance measurement. It's also very, very key. Performance measurement. If you want to know whether management is effective, whether they are creating value. Even here, financial reporting can also be termed as compliance because as I said, some regulators require you to always value the company. So you are valuing to comply with the what? To comply with the conditions. Okay. Among others, risk assessment. So when they ask a question about company valuation, why is it important? You really need to just put a point and explain. Remember, with theory, we just try to defend ourselves. Most times there is no point that is wrong. It all depends on how you defend your point. How you defend your point. For example, you are in the process of, if there is the shareholder exit or buyout agreement, still you will need if a shareholder wants to exit, at that point you need to determine the value. Or if there is a buyout agreements. Buyout agreements. In that process, you need to also to determine in issues of legal disputes, in issues of legal disputes, in issues of bankruptcy, yeah, or even liquidation, liquidation. At that point, you need to determine, you need to actually determine the value. You need to determine the value, among other points, among others. You will just try to get more. But I believe when you meet a question related to this, why company evaluation is important, you can actually pass. Okay. All these ones will help make informed decision. Okay. See, as you determine the company valuation, there are also some challenges you're going to face, because it's not just an easy process. There are some common valuation challenges. Common valuation challenges. It's something that you need also to know. And some of the challenges is that in the process of forecasting, there are some techniques where you involve cash flows. So forecasting the accuracy for future cash flows and earnings can be a challenge. You're trying to forecast how much you're going to earn in the next periods. For example, you're using discounted cash flow techniques. Forecasting those future cash flows is not just an easy process. It's not an easy, and of course, here we are looking at the accuracy. Are your forecasts correct? Okay, so it's something that is not easy. Also choosing appropriate discount rate. Discount rates is not easy process as well. Remember, there are techniques that you need this discount rate. There are some techniques that will require you to get discount rates, even the multiple, because there are also techniques that involve you getting the multiples depending on the technique you're using. Also valuing. One of the challenges here is valuing intangible assets. It's always not easy process. For example, goodwill, brand. It's something that is not easy. What else? Other challenges could be in differences in accounting policies. Across companies and countries. Also, this one is a bit challenging. You need to know the techniques, the methods used, or techniques. All these can be asked. Theory, techniques, techniques. Here you have the net assets method. As you're trying to value the company or the business, which method are you going to use? This is what we are talking about here. The net assets summary, the net assets method. And with net asset method, understand that here it's total. You're trying to look at your total assets, and you subtract your total liability, total liabilities. That is net. That is net assets. Net assets. In short, net assets here, it's equity. You're looking at equity. You're looking at equity. And if you get the total assets minus total liabilities, you will be in a position to get your net assets. And along the way, as you apply the net assets, but colleagues, can you hear me?
I can hear you.
Okay. Along the process, as you apply the net assets, obviously you will always look at issues related to, is it a going concern business? Is it on break? Is it on breakup? It could be the breakup, the breakup basis. The breakup basis, or the going concern. If it's a going concern, now you'll be looking at replacement values. And if it's, let's say, breakup, now here the breakup basis, this is in a scenario like one company wants to take over, the other company, or to acquire the other company, or it could be on the liquidation at that point, when a company is liquidating. So here you will be using the issues related to you will be basing on realizable values. Realizable values. Okay, so it's something that you need to know. And as you also determine the net assets, obviously there would be always the issues related to goodwill. There will always be issues related to goodwill. So here, if you have the market value of the goodwill, then you will capture the goodwill value. But if you don't have, then as you use this method, it means that the goodwill will always be zero. If you cannot tell, or if in the question you don't have the market value, then there is no need of using the goodwill. Goodwill may be there in the question, but we want to know, because what is in the balance sheet could be the book value. But we need the market value. If the market value is not there, then you don't need to include the goodwill. But also, if it's a listed company, if you realize that the question you're dealing with, that company is listed, then the goodwill must be there. The goodwill must be there if a company is listed. So you capture that goodwill in the balance sheet. If you realize that the company you're dealing with is a listed company. But if a company you're dealing with is not a listed company, then you will need to know whether you have a market value in the question. But if market value is not there, then there is no need of you including the goodwill. But for companies that are listed, as you tackle, the goodwill must be there. The goodwill must be there. It's something that you need as well to understand as you deal with net assets. So net assets, you will always look at the total assets, the non-current plus the current, like the assets. You aggregate and get the total. Look at your liabilities. Of course, you will need to be doing some adjustments depending on the question. Okay? Is it okay, colleagues? Is it okay here?
Yes.
Okay. So method number 2, but as I said, you need to know for each method, you need to know when is it applicable, the merits and the merits and limitations. Very, very, very key. Because in an exam, you don't know what they can ask. So as you prepare, don't just focus on calculations. For each technique that we are listing, try to know the merits, try to know the limitations, then try to know under what circumstances can you apply that method. Under what circumstances? Circumstances where a method is, where it is most appropriate, where it's most appropriate. You need to really understand this because you don't know what can be asked. So as in your free time, you need to Google around and know this for each technique, Next technique, price earnings ratio. It's also a common area, and we are going to talk about that using different past paper questions. But when you're talking about the price earnings ratio, you need to understand that here the formula is what? Here you're looking at the market price per share. Here you are looking at per share, then divide by that earning you're talking about here. That earning is what? That earning is the EPS, earnings per share. So as you deal with this, you need to recall this formula. And this is where examiner can throw what? 33. That's where examiner can throw what? The standard. You have to be familiar. How do you determine EPS? So it's something that you need to understand. You are actually not looking for price earnings ratio, but you are looking for the market price per what? That is the main reason why you're using this. You want to know what is the price of each share at the time you are trying to value. So market price per share, it means that it will be that ratio, PE ratio, then times what? Times EPS. Okay, so for you, as you use this method, your aim is not to get price earnings ratio. Instead, your aim is to get this. So it's something that you must understand. It's something you must understand. And as you get PE ratio, especially to a company that is not listed, you will find that you also put into consideration the proxy. If a company is not listed, it's something that you will always put into consideration. For unlisted, you'll always find that in the question you are given a certain ratio or a certain figure, and you have to use that figure, the proxy. You will always find that you're given the figure, and you have to adjust your PE ratio to meet or to be in line with the listed company, especially if they are in the same industry. Okay. What else? Of course, as I said, each method know the merits, limitations, and the circumstances where that very method is appropriate. Please, you Google and know those things as early as possible. Okay, then which other technique? You look at the dividend evaluation, the dividend evaluation method. Now with the dividend evaluation method, this is where Gordon's model will come in. Will come in, and of course here you will be looking for what? You will be looking for what, colleagues? Gordon model. When you recall the other Gordon model, you will be looking for this time you will not be looking for the cost of equity, but instead you will be looking for the value, the market price per share. So you are aware that that formula is KE is equal to what? D naught, okay, D1 over what? D1 over what? D1 over P naught. Then everything you add what? Where D1 is what? D1 is D naught times 1 plus what? 1 plus G. Okay. D1, that is the dividend that has not been paid, or the dividend yet to be paid. It's going to be paid in a future time. But D naught, it's a dividend that has just been paid. And when you're dealing with this, you look at the D1. You don't actually base on D naught. We always try to look at D1, the one that is going to be paid. Not the one that has just been paid. But D1 is always equal to D naught in a scenario where there is no growth in a dividend. Because in a scenario where there is no growth in a dividend, it means that this G will be 0. And it means that D1 will always be equal to D naught. In a scenario where there is no growth in a dividend. But as you deal with valuation of the business, you are not interested in KE. You are not interested in the cost of equity, but instead you are looking for P naught. You are looking for P naught. That is the market. Look at this as the market price per what? Per share, the value of the share as at that date. And it means that here, it means that this one, as you get this, it means that this will be what? This will be what? If you rearrange your formula, this will be D1 over, this will be D1 over what? Because this G will go this side. Okay, so it will be a D1 over KE minus G. That will be the formula as you determine the value, the market what? As you determine it. And of course, in the question, you need to know whether you have the flotation costs. If you have the flotation costs, you need to know how you adjust. They can give you the flotation cost in terms of amount or in terms of percentage. And as well, understand the merits, limitations, and the circumstances where this dividend valuation method is most appropriate. You read that in your free time. Then what else? We need as well, but okay, we need as well to talk about there is the method that is also very, very common, and that is the free cash flows. Very, very common. The free cash flow method, look at it as if it is a discounted cash flow. So here you're not looking at equity, but you're looking at your earnings. The cash equivalent for distribution. The free cash flow is the cash equivalent for distribution for lenders and what? And shareholders. But now, as you deal with this method, colleagues, you need to be very, very careful. Is it free cash flow? Is it free cash flow? Free cash flows to the firm, or it's free cash flows to equity? Free cash flows to equity. You need to be very, very careful as you read. If it's free cash flows to the firm, it means that you are taking into consideration interest here. You are taking into consideration the what? The interest. That is where the most adjustment will always be. The interest part, put into consideration. Put into consideration the interest. But here, you don't need you remove what? You remove interest. If it is free cash flow to equity, because you just want the only part that goes to what? That goes to the shareholders. In that interest on loan or on debt will not go to what? Will not go to, it's not something that is available to the shareholders. Now, and also the other key part is that as you deal with free cash flows to the firm, you need to discount using what? Using WACC. Why WACC? Because you are looking at both equity. If it's a firm, whole company, you're looking at both equity and what? And debt. So the appropriate rate you can use is WACC to discount your cash flows. You use WACC because there is a component of debt. But here, because there is no component of debt or equity, rather, if there is no component of debt or interest, so it means that here the appropriate discounting factor to be used must be KE. You use KE, the cost of equity direct, because here you're not dealing with the debt anywhere. So the appropriate discounting factor is KE. Okay, and as you get the cost of debt, using WACC, cost of debt, it's something that you must also be aware of, that it's good in these questions. What I have seen is that they rely mostly on the risk-free rate of return to adjust the other, you know, when you're given a debt, let's say 10% debenture, 10% debenture, or term loan. If it's 10% term loan. Let me use term loan, 10% term loan. Now, if you want to get the cost of that debt, you get what? You get the rate, then you adjust it for tax purposes, isn't it? That is, if it is pre-tax. Pre-tax, you have not yet adjusted for taxes. If it's post-tax or after tax, then you have already adjusted. Now, the rate to use here, colleagues, here, in a scenario where you have the risk-free rate of return, RF, in the question. If you have RF in the question, don't use 10%. Don't use 10%. Instead, you use the risk-free rate of return, not interest rate. Interest rate is 10%. But if you have risk-free rate of return as 8, don't use 10. You use 8. You use 8. It's something that examiner is using and is consistent with this. So it's something you need to understand, that you may be having the risk-free rate of return or yield to maturity rate that were given in the question. You use that rate, not the interest. What? Not the interest rate. Let me hope that one is clear. Okay. Okay. So it's something you need to understand here with free cash flow to the firm and free cash flow to the equity. Understand those things and they will save you a lot. They will save you a lot. But the question is, how do you determine the cash flows? The net cash flow, the free cash flows. There are some steps you follow from the profit before interest and tax. If it's before interest and tax, or profit before tax, depending on the question given. If you're not given those profit before tax, then you start from sales, then adjust going back downwards. But of course, these are cash flows. You need to adjust the depreciation, you adjust the investment in investment in non-current assets, you adjust the changes in working capital. I believe you know those steps, but it's a journey. Sometimes you're given directly those cash flows, and sometimes you find that you have to determine them. Okay, but this is a method, the method that you must as well understand, and we are going to see this using some examples. Now, what else? There is also the last one, maybe for now. You know, we have a lot. We have a lot of methods depending on the scenario you handle. Yield, yield what? Yield, earnings yield. Earnings yield. Do you know the formula? Do you know the formula? It's something that can be asked even on a ratio number. A ratio number. Do you know the formula? Earnings yield is equal to what? It's simply 1 over PE ratio, over PE ratio. 1 over PE, 1 over PE ratio. 1 over PE, 1 over PE ratio. PE ratio. So it means that here it's like the reciprocal or is it the reciprocal or inverse? Because here already you know the PE from your this formula. So if it's 1 over PE, it means that the earnings yield is simply you just what is on the numerator, you put it on the denominator. So it will be earnings. This is simply the earnings, EPS over market price per what? Market price per share. It's just the opposite, the inverse, the reciprocal. Okay, so that's how you get the earnings yield. Earnings yield. Earnings yield is equal to this. Earnings yield. Earnings yield. Those who are working with Ernst and Young, it's not Ernst and earnings yield. Okay, so but basically for you, you're not looking for earnings yield. You're looking for what? You're looking for market price per share. So market price per share will be that earnings yield given in the question. They will always give you the earnings yield in the question. They will always provide. If they want you to use this method, they provide the earnings yield, and you multiply it with what? Okay, sorry. So you get the EPS divided by earnings yield. That's how you will get. That's how you will get. That's how you will get the market price per share. Okay. So read through the merits, limitations, circumstances where earnings yield may be the most appropriate. Okay. So those are some of the techniques we can use to value the company. Examiner can ask any technique. Now, which one do you want to start with? What? March 2021. March 2021. Do I have that question? Okay. Which screen are you seeing?
Excel.
Okay. I believe now you're seeing March 2021. Okay, March 2021. By the way, read portfolio analysis. We tend to think that it is easy, but you reach in an exam and you forget how to handle those things. I think we have discussed almost all these things. We discussed this number. This one, we discussed it. Okay. Part A. Estimate the maximum price that the shareholders of SUL are willing to acquire WYL using PE ratio method, using a discounted cash flow method. If they say using a discounted cash flow method, what do they mean? Are they saying you use a discount cash flow to the firm or to the equity? I want to hear from you, because if it's a discounted cash flow method, you need to know whether you are going to use the cash flow method to the firm or to equity. So here, what are you going to do?
It depends on the variables given, Abel.
It depends on the what?
On the variables given.
On the variables given. Okay. Let's read through and see. Now we are told that SUL is a listed company on Kampala Stock Exchange with price earnings ratio of 6.0 times. You have the price earning ratio. Okay. SUL specializes in the production of agricultural chemicals for sale on the local market, although some are exported to South Sudan. Okay. As part of SUL's expansion strategy, the directors of the company are currently considering acquiring WYL, okay, a non-listed company that specializes in the distribution of improved agricultural seeds countrywide. Information about the PE ratio of WYL is not available. It's not available, but the directors of SUL estimate that it is about 50% of SUL's PE ratio. That's their estimate. That's their estimate. 50% of SUL's PE ratio. Remember, SUL's PE ratio is this one. Colleagues, are you following? The SUL's PE ratio is 6 times, and they are telling you the PE ratio of WYL is estimated to be 50% of SUL's PE ratio. So if you want to know the PE ratio of the other company, you get 50% times 6. Is it okay? Okay, the extracts of the recent financial statements of WYL are set out below. The summarized statement of profit, you have profit or loss, you have balance sheet. The following information is also relevant. 1, SUL is a fully equity financed entity. Fully, okay? That's why the other person was saying it depends on the what? On the variables given. Here, SUL is a fully equity financed entity with an asset beta of 2.5. Asset beta doesn't involve issues of debt. Asset beta looks at only equity part. There is no financial, there is no the debt component with the asset beta. But equity beta looks at both the equity side and the other one, okay, the other debt component. Okay, so you have the asset beta here. The return on the treasury bills, that is RF, is 8%. However, available market data indicates that the return in the agricultural sector averages to 12%. So that is the return on the what? On the market, RM. And when you see this, think about what? Think about the ways you're going to get cost of equity using CAPM. You must use CAPM here because you're given almost everything. Number Roman 2, it is anticipated that the acquisition of WYL will result into annual profit before tax. This is annual profit before tax. You're given profit here. You don't need to look for profit. You are given profit directly, but this is before tax. Of shillings 32 billion for 5 years. For 5 years. What does this one mean? It means that each year is 32 billion. And you're dealing with 5 years. The annual profits are expected to increase by 10% each year, effective year 2. Effective year 2. So effective year 2, you will increase the previous figure by 10%. However, in year 5, a growth of 8% is expected. So we'll see how to adjust this. Both companies pay corporation tax at 30% payable in the year the tax liability arises. So the tax liability will be in that very year. So it's also very key to know when the tax is payable or when the tax will be paid. It can be 1 year in arrears. If it is 1 year in arrears, then the one of the current year is paid in the next part, the next year. Okay, so how can we use this question to answer part A and part A Roman 1 and Roman 2? This is what we are going to do. So I'm going to start with Roman 1. I'm going to start with Roman 1. This is March. We are starting with March 2021. Question 4. And our focus is on part A, Roman 1 and Roman 2. So using PE ratio, you understand that PE ratio is equal to what? PE ratio is equal to what? PE ratio is market price per share, then divided by what? Divided by earnings, per share. But you don't need PE ratio. For you, you need the market. The question says you look for the market, the maximum price. So for you, you need the market price per share. So what is the market price per share? You get the PE ratio, then you multiply by earnings per share. That's how you will get market price per share. But you need to know, are you looking for the market price per share of SUL or of WYL? What are you looking for here? It's something you need to know. Estimate the maximum price that the shareholders of SUL are willing to pay to acquire WYL. So you need to know what is, obviously you need, since it's UL willing to pay to acquire the WYL, you need to know at what price now, at what price they will pay how much. SUL will pay how much. So it means that you will need to know what is the market price of WYL. It's what SUL, the shareholders of SUL will pay to acquire WYL. Okay, so it means that here we are looking for the market price per share of WYL. So to get that, you need to know what is the PE ratio. What is PE ratio of the company you are going to acquire? PE ratio of WYL will be equal to what? In the question, they told us that what? They told us that the PE ratio of WYL is estimated to be 50% of SUL's PE ratio, and SUL's PE ratio is 6%. So I'm going to get the PE ratio of SUL is 6 times. So I am going to get 50% here, 50%. Then I multiply by 6. And what do you get? This is 3. This is 3 times. So that is your answer. That is your answer. That is your answer. Okay. Okay. Now we need the EPS, earnings. We also need the earnings. per share. Remember, the financials given, statements given are not financial statements of SUL. These financials given are not the financials of SUL, okay? But instead, they are financials of WYL. So how do you get earnings? How do you get earnings per share? To get earnings per share, you will look at the profit after tax. It must be profit after tax. Then divided by the number of what? The number of shares. The number of equity shares. That's how you will get the profit after. That's how you will get, that's how you will get the earnings per share. So the question is, are you given the profit after tax? Remember, this is earnings per share of the other company, WYL. Okay. So are you given the profit after tax? You go to what? You go to your final income statement, that is statement of profit or loss, and see whether you're given the profit after tax. We are given that direct, and as you're picking this, don't forget to carry other zeros. You pick this plus the other three zeros. So it will be, already you have the profit after tax. So it will be this figure. But because we have, you multiply by 1,000. Okay, for you, you carry, I don't know whether, okay, for you, you carry the other zeros. As you determine earnings per share, don't leave out those other 3 zeros. Do you have the number of shares? Do you have the number of shares in the question? Are we given a number of shares? In the question, you are told that equity shares of shillings 1,000, this is per value, 40 billion. Yeah? So it means that I can actually get the number of shares. How do you get the number of shares? Here, this is share capital. You get the share capital divided by the par value, or the face value, or nominal value. So you get 40 billion divided by 1,000. What do you get? You get 40. This is 40 billion divided by what? Divided by 1,000 to get the number of shares. So what will be your answer? This is this divided by what? Divided by what do you have? It's 40 million, eh? Divided by 40 million. So finally, what will be your earnings per share? Your earnings per share will be equal to,
I have 474.
You have 470. I can even get it direct here. All right. That's what you have. This is per.
Yeah, that's it.
You see the amount. Remember, this is shillings. This is shillings. That figure per share. This is per share. So you have the earnings per share. So it means that you can be in a position to get market price per share of WYL. So market price per share will be what? Market price per share will be what? You just multiply. You get your PE, then you multiply it with this one. Because that is the formula. They are telling us that market price per share is PE ratio times earnings per share. So when you multiply, what do you get? Here we are getting 3. times 474.25. Okay, so the market price per share will be shillings. When you multiply, what do you get? When you multiply, what do you get? Shillings.
I have 142.75.
142.
2.75.
2.775. Okay, this is per share, and that's all. But the maximum, they told us that you look for the maximum price, the maximum price that the shareholders of SUL are willing to pay. So, of course, after knowing the market price per share of WYL's shares, then you can be in a position, to know the maximum price that SUL will pay will be the market price times the number of shares. That's what they will pay. Yeah. So you get 1,422.75. Then you multiply by the number of WYL's shares, and those are what? We saw that the number of shares are 40 million. So you multiply by 40 million shares, and what do you get? That will be your final answer. You get this 142.75 times the other 40 million, and that's the maximum price or the amount SUL will pay to acquire WYL. Any question? Any question? We are done with this Roman 1. We are done with Roman 1. We are done with Roman 1. Okay, then Roman 2. Roman 2. Roman 2. Now we are using, we are using someone who was asking about earnings yield. Someone who was asking about earnings yield. Even here they can ask you, and before we go to Roman 2, let me just highlight on earnings yield using the same question. Earnings yield is equal to what? 1 over PE, 1 over PE ratio. 1 over PE. Here in this question, you can actually get earnings yield. How? Your earnings yield can be 1 over PE ratio. Already you have the PE ratio, so it can be 1 over what? 1 over PE ratio, and PE ratio is 3. So I can simply get 1 over 3 to get my earnings ratio, 1 over 3. Remember, if you're not given that, then you will follow the steps. So it means that you will get this, and the answer 1 over, this is 1 over 3. That's what you get. Okay, let me go with this. As my earnings what? As my earnings yield. Once you have the earnings yield, then you can be in a position. You can be in a position to know the market price, because now the market price is equal to what? The market price is equal to what? The market price using earnings yield remember here the market price is EPS divided by earnings yield. When you look at what we did here, from 1 over PE ratio, you can be in a position to get the market price per share. That is the earnings per share divided by earnings yield. Okay, so it means that you can be in a position, to get the market price per share, and this will be earnings per share. Earnings per share is 474 point what? 474.25. Then divide by, looks like I multiplied, maybe divided by this. That's what you have. That's what you have.
1 4. Anyway, that is it. I think because of the recurring thing, but I have 1,437. It is okay. 1,437 is what we have.
Like
I only
this,
took I only took 2 decimal places.
like
it is
this.
okay. It's fine. It's okay now.
It must be the same. It must be the same. This is per share. So colleagues, you see, still you go back at what we had at start. Even using earnings yield, you still go back to what we had at start. Using that method, because at start still our using PE ratio, still our answer, our market price per share was this one, 1,422.75, and that's what we have again. So it means that still the maximum price that the maximum price that SUL will pay will be this figure, then times the number of shares, 40. And that's the answer. Okay, so we are done with 2 methods. Let's go to using the next method. We are going to this method. And back at our question. Back at our question. Okay. Colleagues, as you read this, as you try to tackle this method, discounted cash flow method, as I said, you need to know whether you are going to use free cash flow to the firm or free cash flow to the equity. But as you can see here, colleagues, you can actually think about free cash flow to the firm. If you see in the question you are having issues related to debt, if the company trying to acquire the other one has a component of debt, then at least there you can think about what? You can think about a free cash flow to the firm, because here the examiner was not open. But at the same time, here, as you're trying to acquire, you are actually looking at equity. What is the market price of the other company's shares? And you can get that basing on the what? Basing on the equity component only. Now, what you're going to do with this one, you are going to answer it as if you're answering using the method of free cash flow to equity, not to the firm. Okay. Now we are told that, remember, as you're using here, we will use this, will be our free cash flow, our free cash flows to the equity. And I believe now you know the reason why you're looking at that. This is equity finance. When you look at our question, the one acquiring is using equity finance. SUL is fully equity financed entity. Fully equity financed entity. So there you don't need to think about what? You don't need to think about the other one of work. You discount using the cost of equity, not work. You can only use work if there is a component of debt. Okay. And we always look at the company acquiring. They are using which kind of finance to acquire the other entity. Okay. So SUL is a fully equity financed entity with the asset beta of this. So we can first get our discount factor, that is using CAPM from the cost of equity. Remember, if a company is only equity finance, that is ungeared that you're using cost of equity, which is ungeared. Which is ungeared, because there you're looking at only equity component without debt. Okay, so it will be equal to what? It will be equal to RF plus the asset beta. It will be RF plus asset beta. You know the sign here. I don't want to give myself, but you know the sign. Don't put P. Put the sign of beta. I'll put the other sign of, how is it called? Put that sign, you know it. So it's RF plus asset beta. This is asset beta, not equity beta, asset beta. Then times risk premium. Risk premium is RM minus what? Minus RF. Okay. What is our risk-free rate? Our risk-free rate is the return on treasury bill, that is risk-free rate, 8%. This is 8%. Then plus, what is our asset beta? From the question, it is 2.5. Then times the risk premium RM. RM is given as, that is return on market, that is 12%, minus RF, 8%. What do you get? This is 8 plus plus 2.5 times colleagues, you use your calculator. Plus 2.5 times, use your calculator and tell me the answer.
I have 18.
Okay. It's 18%, yeah, 18%. Okay, so that is our discount factor we are going to use as we discount those cash flows, the future cash flows. Now you can make a table. Here you have details. We are dealing with how many years here? We are dealing with how many years? It is anticipated that the acquisition of WYL will result into annual profits before tax of this for 5 years. So we are dealing with 5 years. So it will be, I have year one. I have year 1, year 2, year 3, year 4, year 5. We can have our figures in millions. You can just even put it up. Figures in what? Figures in a million, so that you don't waste time on this. So you start with the profit, the one given in the question, that is profit before what? Profit before, that is profit before what? Profit before tax, before tax, before tax, before tax. And what are we given? We are told that it is 32 what? 32 billion. Yeah, 32 billion, but we are keeping 6 zeros. So it is 32. Here I'm going to put 32,000. But it's going to increase. It's going to increase. This figure is going to increase. They told us that the annual profits are expected to increase by, this is an increase by 10% each year, effective year 2. So in year 1, it is 32, but effective year 2, it will increase by 10%. So what does this one mean? It means that now, to get my figure for year 2, I simply get 1.1. That is an increase. What you have 100%, you increase it by 10, you get 110%. That is 1.1. So I get 1.1 times this. That is the easiest way you can do. Or you first do your one winter style, this one plus what, 10% times, but this one wastes time, plus this. You still get this figure. Okay, this one is increasing. Our annual cash flows are increasing, or our annual profits are increasing by 10% each year. Each year. So it means that even here for the next year, for year 3, it will be 1.1 times times this. Then here it will be 1.1 times times this. But they said that on year 5, however, in year 5, a growth of 8% is expected. How do you handle this? How do you handle this? A growth of 8% is expected. How do you handle this? A growth of 8% is expected. How do you handle this?
I think the growth rate reduced from 10 to 8. That's what I can put across.
Yeah. So here you will use 1.0, 1.08 from 10% to 8. So you multiply by this. All right. So you need to be very, very careful here. What is like reduced to, increased to, increased by, reduced by? Those words are very, very key. So we have profit before tax. We have profit before tax. So you can go ahead and get your, because we don't have any other adjustment. We don't have any other adjustment here. Any other adjustment you could do here could be the one of interest, the one of interest, but that one also comes after tax. Okay, so here we can get the tax. The tax is what? This is at 30%. So you just get your answers. You multiply by 30%.
How did you get the 45,999?
Eh? Oh, we get to the 70% direct. Pardon?
How did you get the 45,999?
Here. Because in the question they said in year 5, in year 5, it's a growth of 8%, not 10%. So it means that you'll get 1.08, then times the previous figure. Is it clear? So the tax, we get 30% times, but this one wastes time in an exam. Actually, someone who is smart can immediately get profit after tax. As you get here, you just skip this, and or as you do in an exam, what I normally do here is profit after tax. Once I get this, before I move to the next, I also first get the answer. This one will be still on your calculator. You get 32 minus answer before you go to the next. Then once you get 35,200 minus answer. Like there you want to waste time. So here you multiply by this. This one is okay. Get this minus your answer on calculator. So here it's 30%. 30% times this. Then here it's 30% times this. All right. All right. So that's what I have. Any question? Any question? So that is my profit after. That is my profit after. That is my profit after tax. That is my profit after tax. So once I have my profit after tax, I can discount. What is my present value of interest factor? This is at what? At 18%. Because I don't have any other adjustment. Like now, if you realize that you have interest, if you realize that you have interest in the question, you first remove the interest if your cash flows involve interest. Okay, so we'll see that that question was asked. I think we'll see that in September using the same number. We'll see that. Okay, so here you tell me the discount factors. The discount factors at 18%. Fernando, put some speed.
And then 0.516.
516. Here we get them from the table. Then here
0.437.
437. We don't have. If you want to use the formula, this is it's 1 plus r. It's 1 plus r, which is 18%. Then power negative n. That's how you get. That's how, like for year 5, you get 1.18 power negative 5. If we want to get for year 5 here. Okay. So finally, what is our present values? Our present values. We multiply. We get this times this. Okay. That is our present. That is our present values. Okay. So finally, you can get the total PV. You can get the total present value. You can get the total present value. So it means that here the total present value, the total present value will be equal to you aggregate, you add, sum up. You add all your values here. And that's what I have. This will be million. So that is the total. That is the total value. That is the total value. So if you're to use the discounted cash flow method, then you'll end up paying this money. You'll end up paying this money. This is the value. This is the value you can pay. But if you use the other method, you pay this 56. This will be the value 56 point what? 0.91 billion. But here you're paying 82 basing on the cash flows. Basing on the cash flows. So we are done with that question. Just time is taking us. Let's look at September 2022 as well. Question 3. September 2022, question 3. And what are we given in that? What are we given? September 2022. September 2022. Let me open the question. So that we will do this at once. Which screen are you seeing? Which screen are you seeing? Are you seeing September 2022? September. This is question. Colleagues, go through this number ratio, the ratio analysis number. Never know. And go those, you can even go through the level 2 numbers about ratios. You never know. Or you go through those advanced financial reporting ratios. But for us, we are interested in this part A. Question 3. Question 3. Part A, you have 13 marks. You have 13 marks there. Advise the shareholders of PUL on the appropriate price that should be paid to acquire DLL using free cash flow method and the price earnings ratio. Okay. So the question is, are you going to use the free cash flow to the firm or free cash flow to equity as you discount your cash flows? So you need to pay attention and see what is the information given, especially when it comes to PUL. When it comes to PUL, as you are acquiring the company, as you are acquiring the other company, are you using both equity and debt or not? And obviously, the examiner will try to give you such kind of information. Okay. Let's read through and see. Predator Uganda Limited was established in 2014 as a limited company operating in the transport sector. At its recent board meeting, it was resolved that PUL expands its operations in the transport sector by either acquiring new buses or acquiring another firm that is already operating in the same sector. Cost of equity or work? Weighted average cost of capital. So PUL has a debt to equity. You have a component debt to equity ratio of 40%. Now, if they say debt to equity ratio of 40%, then it means that you are the one to know debt is what, equity is what. In this scenario, debt carries which percent? 40. Debt 40, then equity 60, isn't it? Okay. And an equity beta, are you seeing this now? Here you're given equity beta. Why? Because this company is financed by both debt and equity, not like the other question of March 2021. The one of March 2021, we are given asset beta because the company was financed by only equity. But here you're given equity beta because the company is financed by both debt and equity. Okay, information available on government securities indicate that these securities yield an annual return of 8%. That is RF. While the market rate of return averages to 200% of return on government securities. So what you do to get the return on market? What do you do? Return on market, you get you get what? The return on government securities is 8%. So to get the return on market, you get 200% times 8%. Okay. PUL estimates that the acquisition of DLL will result into the following annual cash flows over the years. So you have the cash flows. You have the cash flows. Okay, now you need to pay attention. Are these cash flows already, or are these cash flows after tax or before tax? You need to pay attention. In a scenario where your examiner is quiet and you cannot tell, then you assume that these are cash flows before what? Before tax, and you adjust them for tax purposes. But sometimes examiner is clear. Like now, read the additional information here. They are telling us that the estimated cash flows above are net of what? Are net of tax. Are net of tax. These are after tax. These are after tax. So you don't need to again what? You don't need to again adjust them for tax purposes. But they are saying, but growth of interest expense. What does that one mean? But growth of interest expense. It means that they have already included what? They have already included the interest expense in these figures here. You have also the interest expenses within those what? Within those figures. Okay. And it has been established that DLL has an issue 20% term loan, 5 years. Okay, this is term loan worth 7 point. Okay, additional extracts from DLL's recent issued financial statements for the year, okay, show that the company is registered an after-tax profit. This is after-tax profit. After-tax profit of 1.4 billion and has PE ratio of 5 and 200,000 free issued shares. The reason why you have this is to answer Roman 2. 3 marks, 3 marks here. So what can we do? You can start with the other part, which is a bit easier. I can start with part A, Roman 2, but you guys, are you still on? Am I finding I'm alone here?
We are on.
We are out.
on.
Okay. So we are going to use using PE ratio. Using PE ratio. Remember the formula? PE ratio. PE ratio. PE ratio is equal to what? Without checking in your book. PE ratio Just understand the P is the market price, market price per share. The price you're talking about here is the market price. Then divided by what? Divided by EPS. EPS, earnings price per share. But you don't need the PE ratio. Instead, you need the market price. And as you do this, you need to know it's the market price of which company, the company you are acquiring. Okay, it's the market price of the company you are acquiring. That's what you're trying to get. What is the market price of the company you are acquiring? So here it's the market price of DLL, market price of DLL, of DLL's shares, of DLL's what? DLL's shares. What is their market? What is the market price? Okay, so it means that this one is equal to what? The PE ratio. It will be this PE ratio, and this PE ratio is the ratio of DLL, PE ratio of DLL, okay? PE ratio of DLL. Then you multiply by EP, what? EPS, because you're trying to get this one. You're trying to get this one. Okay. So are you given everything? Are you given PE ratio of DLL? We are given PE ratio as 5 as 5. This is 5 times. Okay, you're given this as 5. So are you given earnings per share? You are not given earnings per share, but you can get. So from our question, PE ratio. From our question, PE ratio is actually 5. Then earnings per share we can get the earnings per share, and the earnings per share we say that it is profit after tax. Then divided by number of what? Number of equity shares. Number of equity shares. That's how you get the earnings per share. Are you given the profit after tax? Yes. How much? You are given the profit after tax direct. You don't need to again adjust it. Already what you have, this profit is after tax. So don't adjust it. Take it as 14 billion. So it's 14 is it 14 or 1.4? 1.4 billion. 1.4 billion. Then you divide by the number of shares. How many shares? Here we have the 200,000 free issued shares. 200,000. And what do you get? What do you get?
7,000.
I
have 7,000.
You get 7,000.
Yeah.
Okay, 7. This is shillings. 7,000. This is per share. This is per share. So once you have your earnings per share, substitute in your formula. Therefore, your market price of this company will be equal to you multiply. You get 7,000. That is EPS times the times the 5. So that is the price per share, the market price per share. This is per share. This is per share. So if you want to know the total now, the total value, the total value or the total price to be paid, the total value or price to be paid to acquire DLL, to be paid to acquire, you will need to pay how much? You multiply. You get 35,000, then multiply by the number of shares, 200,000. And you'll be in a position to get now the price that examiner wanted. Okay, so you get this times 200,000. 100,000. And you have your max. Yeah? We have our max here. Okay, so we are done with that. 5 max. We are done with that. 5 max. This one, 5 max. Then Roman 1, using free cash flow method. Okay, then here Roman 1. This is part A, Roman 1. So I am using free cash flow method. And how do you approach this? Since you observed that the company acquiring DLL is both equity and debt financed, then you must use the free cash flows to the firm so that you discount your cash flows using WACC, because the company acquiring is financed by both equity and debt. In that situation, automatically you must use WACC. But if the company acquiring is only financed by equity, then you use a cost of equity. We are told that the PE ratio, debt to equity ratio is we are given what? The other one was 40%. It was 40% debt to equity ratio from our question. Here 40%. Now this means that debt is what? The debt component alone. The debt component here. This company finances their activities. The debt component is 40. It's 40%. It's 40%, the debt component. Because if debt to equity is 40, it means that here it's 40. Its debt is 40, then equity is what? The remaining percentage. Equity is 60%. Okay, you need to know that. Then from our question, we are given also equity beta. And the reason why you have equity beta, it's because this company is financed by both debt and equity. Equity beta 1.5. Okay. What else are we given? We are given risk-free rate, return on government securities as what? As 8%. As 8%. Then what else are we given? In an exam, don't do this. Just hit direct, answer direct. Then here, return on market. Return on market, we are told that it is 200% times 8 from the question. When you read the language, they told us that the market rate of return averages 200% of. So you multiply of the return on government securities, and the return on government securities is 88%. Okay, so here what do you get? What do you get? The 200% times 0.08. You get this in a percent. Okay, so you have everything. I can first get cost of. Now I can first get cost of equity. What is the cost of equity? What is the cost of equity? That is KE. How do you get cost of equity? It's RF plus equity beta now, equity beta, then times the risk premium, that is RM minus RF. So which is equal to what? RF is 8%. I add the equity beta 1.5. Then I multiply by RM 16% minus 8%. What do you get? What do you get?
20%.
You get 20%. You get 20%. That is the equity. What about debt? Debt, as we said, we use what? Risk-free. Do you remember?
Yes.
The debt we use, that's what I said. We use for the debt component. You use the return on
rate.
government securities. That is risk-free rate. So what will be your cost of the cost of debt? Cost of debt. That is like KD. It will be the RF. The RF, you adjust this for tax purposes. 1 minus tax rate. 1 minus tax rate. So this will be the 8% times times 1 minus 0.3, which is the same as 8% times 0.7. What do you get?
5.6.
5.6. 5.6. Perfect. Now, overall, what is your work? Overall, what is your work? Weighted average cost of capital will be Are you now, because you have the percentages, you don't need to use the other. Already you know the proportions. You know the proportions. So here the weighted average, the weighted average cost of capital is, if I look at the equity component, is the cost of equity times the proportion of equity. Then plus whatever you get, you add what? You add the cost of debt, that is KD, times what is its proportion, the proportion of debt. Okay, and you'll be in a position to get your work direct. So it means that here I'm getting the cost of equity. We have as cost of equity as 20% times the proportion. Now the proportion, please don't, for you to use your calculator in the right way, use the decimal points. Don't use the percentage. So the proportion of equity is 60%. So I multiply by 0.6. Okay. Then plus what? Then plus the debt component. We saw that the cost of debt is 5.6%. Then times what is the proportion of debt? 0.4. So finally, what do you get? Use your calculator direct and get the answer. Open bracket 20%, or you can simply say the 20 times 0. Here, when you use this format, just get 20 on your calculator. 20 times 0.6 plus open bracket 5.6 times 0.4. What you get, the answer will be in percentage. Are you having, what do you have? 14 point what? Do you have 14? 14.24?
14.24.
14.24. 14.224. So you can approximately use what? You can approximately use the 14% as your work. So finally, once you have your work, you can now do your table. This is details. Net of tax, it means that they have already deducted the tax expenses. So you don't need to deduct them again. Now, and now, colleagues, what are you going to do? What are you going to do with this question? We are given the cash flows after tax. We are given the cash flows after tax. Are you going to remove here the interest, or you're going to discount this the way they are? What do you do? What do you do? Remember, this is free cash flow to the firm. Free cash flow to the firm.
Since the interest is already added, we leave it there. We don't subtract it.
We are not going to subtract. But if you're dealing with free cash flow to the equity, and you have such kind of statement that these figures you have a growth of what? Interest expense. Then you need to go ahead and remove. You go ahead and remove interest expenses. You remove the interest expenses. And how do you get the interest expenses? How do you get the interest expenses? Now it could be you get you can look at it, because now you will be valuing the other company. You will get this one, the 20%, this one. You adjust it for tax purposes, then times this. That will be your interest. You remove that interest. If I told it, someone in the chat, what is there a question or I'm missing the chat? Yes, for free cash flow too, we use the cash flows net of tax. Yeah. That is true. Okay, so let me hope you have understood. In a scenario where it is free cash flow to equity, what you would do is to raise here the interest expense. And what are those interest expenses? The interest expense of the other company you're trying to acquire. Okay, that's where you focus. So you get the debt of the other company, the 20%. You adjust it for tax purposes, 0.7. That will be the interest rate after tax. Then you multiply by the what? By the amount, the 7.5 million. Those expenses you get are the one you put here for each year, and you raise them. But because here we are dealing with free cash flow to the firm, you don't need to do this. Already it is what? It's growth of, and we deal with this one with free cash flow to the firm. We deal with net of tax, but growth of interest expenses. So simply here, what you will do is to discount. But before you discount, you can first deal with this one, which is 5 years onwards. You first get the perpetuity value. So if you do this, let me try to get the perpetuity. This is like, how do you do this? You discount 1 over work. The reason why I'm using this, because there is no growth in dividend. But in a scenario where there is growth in dividend, then you have to do the working. Remember, terminal value, this could be like the terminal value, or the perpetuity terminal value, or perpetuity value. You have, it's the free cash flow, or cash flow in perpetuity, free cash flow in the perpetuity, then times 1 plus B, then everything over, you have this formula in the formula sheet, then over Then over what? Over K minus C. If you're dealing with work, then it would be work, KE, work minus what? Minus V. That is if you're dealing with, if you realize that you have a growth in dividend. If you have gain in the question, you have to first use this formula to get the terminal value. But because now in the question we don't have G or the dividend growth rate, then it means that where there is G, it's 0, and automatically you are going to be just using 1 over work. If you're using cost of equity, still it is where you have work, you put KE, but the same concept. But when you realize that you have G in the question, then you need to use this formula to get the terminal value direct. You get the terminal value direct instead of first doing this. Okay? Or if still you can even do this and get the answer, terminal value direct. So here it will be 1, this is 1 over what? What was our work? 14%, 0.14. And that is I can increase this to 3 decimal points. Okay, so it means that the terminal value here, the one you should discount, it's this one times this. It's the one you should base on as you discount. It's the one you should base on as you discount. So it means that here my values, or you can even leave like this and just because in an exam you're dealing with time now, you can immediately just leave a space and get the present. This is the terminal. You can call this one terminal value. So present value of interest factors at what? The rate we are using is 14%. So tell me the answers very fast.
No, we have 0.877.
We have 0. What?
877.
Then here, just a minute. Okay, then here.
They have 0.769.
Then here,
675.
675. Then next.
0.592.
0.599. Then next. Okay, now here you have to pay attention.
Abel,
Yes, please.
maybe we first confirm this figure. When we divide by work, my figure is 7.023, not 7.143. Such that it gives
where we have terminal benefit, rather terminal value. This one.
yes.
Colleagues, what do you get? 1 divided by 0.14.
It's what I get.
7.143.
What was there was correct.
I don't know. Try to again do 1 divided by 0.14.
I've got it. I didn't round off.
Oh, okay. Oh, all right. So here, colleagues, pay attention on this. The last one. As you discount the terminal value, you use the previous one, this one. You use the previous one. So in an exam, don't use the year 5 discount factor. So you just use the previous one. You retain the base. Okay. Now finally, you can get your the present values. You can get your present values by multiplying. I simply get this times this. Then up to here, then here it will be this terminal value times 0.5992. So that's what I have. If you have different figures, you can as well let me know. So finally, what you're going to do? Finally, what you're going to do? Finally, what you're going to do? You can get the sum, the total. First, get the total present values. Total present values. Remember this one. These ones you're getting includes both equity and debt. Okay? What you're getting, the total present value you're getting includes both equity and debt. Okay? This is in a million. And because it includes both equity and debt, and for you, you're interested in the equity component, then you will need now to get the price, the total price, the total price to be paid, would be the other total, the total PV minus the total debt. You remove the total debt, the total debt. The total debt of what? Of the other company you are acquiring, the total debt. This is the overall value of DLL. It's the total value. This is the total value of total value. Let me just say total value of the what? Of the company. But you remove the debt component, the total debt of DLL. So finally, what you will need to pay, it will just be the 17,572.99 million. Then you remove, what is the total debt of the other company? The total debt of the other company, they told us that this company has a debt of 7.5 billion. It has a debt of 7.5 billion. So you remove that. That is 7,500 million. So finally, what you will pay, you only need the equity component, because there you'll just be like the debt, the other debt can be covered by the other person. So here, what do you get? You get this figure minus what? Minus 7,500. And that will be the value. So using this formula, you pay this. Then using the other formula, you pay how much? 7 billion. But using this one, you pay this. Okay. I think we are done with free. We are done with free. We are done with free what? Free cash flow method. But take note that if you're using free cash flow to equity, then here you go ahead and remove. Anyway, let me just do summarize here. Let me just do summarize here. Let me just do summarize. 'Summarize' here. 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 'Summarize' here if you're dealing with free, if at all, assume it, it's free cash flow at equity. What do you do? Once you put these values, then first remove debt. Rather, first remove interest. And the interest you're removing is the interest of the other company you're trying to acquire. Okay, so you simply remove the interest, which is you do the working down the interest expenses. The interest expenses would be here. You simply get the interest. This time you use the interest. The other one, the 20%. The 20% times 0.7. Here I'm adjusting for tax because tax is one. Here, if you want to know the after tax interest, it's just 1 minus t, which is 1 minus 0.3, and you get 0.7. Then times the total loan, which is 7.5. This is 7,500 million or 7.5 billion. So the interest expense here, the interest expense would be how much? Would be how much? 20% times 0.7 times 7,500. So that will be your interest expense for each year, million. So you come and put those the expense each year. Each year you're putting this. Each year you're putting this. Okay. Then finally you get your figures to discount. You get this one minus this. You do the same for all. But then once you get this, you go ahead and get the what? The terminal value. The terminal value. You can even put here the terminal value direct. The terminal value. The terminal value. Or you first get, but here it would be good. You just get the terminal value. The terminal value, you come here and adjust this. You adjust this. Now, it will be this figure divided by what? Divided by KE. KE was what? KE in this question was what? KE in this question was 20%. Yeah, KE. You divide by 20%, 0.2. The same way we divided by worker for this one. Here we divided by worker to get this. So here you also divide by KE, because if it's free cash flow to equity, you're discounting using KE. You must use KE here. Okay, so that will be your terminal value. Once you get your terminal value, then you get the present value of equity factors, and at what? At 20%. That is KE. You use KE to discount. You use KE to discount. Okay. So as you're discounting, you're using KE. And here it will be what? You put the discount. 0. What? Here you see I have 0.33. Okay. This is 0. What? 0.6. Let me hope that's what you see there in your table. This is 0.79. This is 0.452. Then the last one will remain the same like this. So finally you get the PVs, the present values. And as you get the present values, you are getting this 700 times this. Okay, you do this up to here. Then here you are getting the terminal value. You are getting the terminal value times this discount. Then finally Finally, you will get your total. You will get your total. Your total what? Your total value. Your total value. Total value. Total value of equity. Total value of equity. The one you want, direct. The total value of equity will be the total PVs. Because here you are looking at only equity. You don't need to remove, you don't need to get the total, like the way we did here, the total value of the company minus total debt. Here you are purely looking at what? You're purely looking at equity. You're not looking at debt. So you will not subtract the debt component. So you simply sum. You simply add all these values to get your answer. And now you would pay this amount of money. I think that's all. What are we left with? We are left with two methods. The other method is of we are left with the net asset and the Gordon's model. Let's discuss them tomorrow as we do other things. That's what I will do tomorrow. Finalize this, then we do other numbers of corporate restructuring.